Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Call Tesla what you want, robotics company, AI company, but the fact of the matter is the vast majority of revenue and just about all of the profits come from the automotive side of Tesla's business. Therefore, as far as financials are concerned and the short-term success of this company, Tesla's automotive business is what matters. In fact, I think very little of the AI, robotics, or even energy side of Tesla are priced in. I would say the large majority of Tesla's market value is due to the number of EVs they sell. The success is contributed to the huge profit margins Tesla achieve through this, due to Tesla achieving great economies of scale, partly through so much vertical integration. One of the major vertical integrations being the car dealer network, an entire step of the supply chain process completely removed and is now superfluous for Tesla. Therefore, Tesla derives huge profits from every vehicle they sell, and Tesla is seeing significant growth. And if it can be maintained, then the vehicle sales business alone should generate enough sales and profit to warrant the current stock price. Within perhaps 3 or 4 years, Tesla could justify a $2,000 stock price with a PE ratio of just 30, solely from their vehicles sales business. That would be if Tesla was just a car business. Almost all of Tesla's stock price is based on the success of the vehicle sales, and Tesla likely only need to hit a few million vehicles a year to even achieve what I mentioned. Tesla will clearly have enough demand for this many vehicles, and the margins Tesla get are going to only increase that much more. Therefore, it is not going to be a huge struggle for Tesla being just valued as a car company, with all their current manufacturing technology and processes to likely double the stock price in just a few years, or whenever Tesla can hit a run rate of around 3 million or so vehicles a year. The vehicles business is the most tangible product we can judge from Tesla at the moment. It is all so new. Elon has made such big claims and promises and many times has not delivered. Yet in other areas, Tesla are excelling and they're not getting the credit they deserve. Therefore, what really counts is the profit that can be generated, and with such large products that are so expensive, giving such high margin, when their sales get into the multi-millions, the margin on them alone will be enough to justify a solid stock price. If Tesla can also show that more growth can continue, then really a PE ratio of 30 should be more suitable, thus giving a $3,000 or $4,000 stock price. Again, just for vehicle sales. And the FSD, but at what Tesla are getting at today's rates, with deferred revenue included. We're not pricing in Dojo or Robotaxis. The batteries are the core product, but it's going to be the software that makes the most profit. We're not even including the fact that FSD could be complete by this stage too. We're not pricing in any AI or humanoid robots, and we're not even pricing in the entire energy business here, solely the auto side of the business. Why am I saying all this? Well, the other sides are not so priced in. Well, they're a long way away. It's going to be years before we see any of them get close to the sort of profit Tesla are making on the vehicles alone. So if you want the best guidance of stock price in the interim period, then it will be all about watching the vehicle production Tesla are reaching in the meantime. I don't think very much will happen with FSD for a while, in that it will actually make the stock price jump. I think regulatory approval will be a big step, but then it will take some time until FSD profits or even Robotaxi profits are actually noticed in the company. The amount of profits just from the vehicles is going to be hard to match, and these other services will take some time to catch up and expand. Therefore, Tesla's stock price, for now, is going to be all about vehicle production and ramping up. What is keeping them constrained, you might wonder? And why haven't they announced a new factory yet? Well, the constraint is the same as it always is. Not enough batteries. So any new factories will be built at the same rate Tesla are able to increase their own battery supply. Of course, Tesla has demonstrated it is a company about more than just vehicles, and thus some of the future software and energy products are somewhat priced in, and thus we do anticipate a higher PE ratio as a result. But any price to earnings ratio, well, the vast majority of those earnings for Tesla will still come from their vehicle sales. The margins are just so high on expensive items, it just becomes so much profit when you start selling multiple millions a year. A robotaxi network could possibly make $1 trillion a year or something, depending on how large it becomes. The thing is, even if that was the case, it would take a long time. The robotaxi income, as profitable as it may be, will take some time to build up, as will the infrastructure accompanying it. This is why a lot of people are holding Tesla stock until past 2030, as there is so much more for this company to do. This level of growth and transition will take some time. However, Tesla will continue to grow exponentially through this. We often talk about a lot of the potential for Tesla, even just 2 or 3 years away, but it's really going to take a lot longer than that for Tesla to be out of its growth stage. I think it likely Tesla may end up producing more like 40 million EVs a year too, and Tesla didn't even hit 1 million in 2021. We're about 2% of the way there, just for vehicle sales. And then if the energy business is as big again, well, you get the idea. But the majority of the earnings will come from vehicle sales for the foreseeable future. And if you want to judge the stock price in the near future, it will be based as to how many vehicles Tesla are producing, which will depend on how many batteries Tesla have at their disposal. But as we're saying, that there is a good chance that Tesla can get up to producing a few million vehicles a year within the next few years, and that alone can justify the value of the company it is even today, in the ballpark of 3 times more vehicles produced and generating about 5 times as much profit due to improved margins and higher economies of scale. Although I am of the belief Tesla can possibly ramp up a lot faster than that. As Tesla fans, we understand how valuable the likes of autonomous or robot vehicles are, but it's hard for a lot of people to imagine or even grasp, let alone put a dollar value next to it. We may realize the dream now, but we will not realize the profits for some time. Until then, vehicle profit is going to be massive with these really high profit margins. This will be enough to keep the stock price racing for the next few years, also supplemented eventually by energy, which should be a no-brainer. But the real value will be robotaxis and the energy auto bidder system. This will take much longer to prove to the market of its value. And like I said, if Tesla is selling 5 million vehicles a year and getting about $25,000 gross margin per vehicle on average, including FSD, then that's $125 billion gross profit just from vehicles, which is still enough to push the stock close to $5,000. And then still a lot more ramping to come from there. That gross profit is also an absolute fortune to have to try and match. So any other size of the business will not really be noticed when compared to this massive amount of profit, not until they start becoming substantial. Even if robotaxis is validated, regulated and everything, it will take a long time for them to become the full service intended internationally. And as shareholders, there'll be some waiting for the business to hit new levels before the stock price has. So for valuation purposes, it's really the car side of Tesla that we need to be looking. And for some time, that is going to be the best way to value this company. The value will come through continued ways of saving costs in production whilst increasing production rates. The vehicle production is going to come down to battery production, so keeping an eye on the level of battery production Tesla is reaching will be what is key here. It looks like Tesla will have an additional 80 gigawatt hours a year from CATL for China. The rest of the battery expansion will be coming from what Tesla can produce this year with their 4680 lines in Texas and Berlin. So much of the company is riding on that and the future. We need this year to validate these batteries and see what Tesla can really do. This is going to be a very critical year. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.